Jonathan Garner, Chief Asian and Emerging Market Equity Strategist with Morgan Stanley, joins us live. Jonathan, good morning. Thank you for joining us. Jonathan, nothing new has come out from US Fed last night. Would you say that what the minutes of the FOMC meeting are clearly indicating the obvious, that the tapering will start and tapering will start soon?
Yes, we've thought for some time that tapering would begin in September. We've been at pains to mention that tapering is not the same as actually tightening. It's still likely that we're well over a year away from the first Fed rate hike, but it's the bond market reaction that is most important, and the US 10-year going to 2.9% is further pressurizing emerging markets that have funding gaps.
Jonathan, hi, morning. What's the quantum cut that you expect in bond purchases? Because consensus feels that Fed can start with lowering, firstly, about $10 to $15 billion in September. Would you agree with that figure?
Yes, that would seem about right, maybe slightly more. But the key thing really is to assess not so much the tapering, but the market reaction to the overall policy trajectory over the next couple of years. And our view is that the US economy is now entering a sustainable growth upswing. We think it'll be growing more than 3% in the fourth quarter. And so we think there's further upside risk to those bond yields. And it's the bond yields that matter more for the pricing of the global cost of capital. And it's that's already having an impact on the emerging world, including India.
So where do you think US bond yields eventually would settle? Because it's been a one-way street for US bond yields. About 2 quarters ago, they were at about 1.5, from 1.5 to about 3. That's a big jump there.
Yes, it wouldn't surprise us if we see a 3% plus 10-year bond yield at some point in the first half of next year. But obviously there are limits to the kind of upside we might get. Inflationary pressures, for example, in the United States are very subdued still. And so, we've had a big move already. Unfortunately, in the emerging world, this is already causing significant problems. There's a backup in bond yields happening, particularly in what we've christened the Fragile Five, which includes India, Indonesia, Brazil, Turkey and South Africa. They're all experiencing the same cocktail of issues of currency weakness, backing up of the domestic bond yield by far more than the core US yield has risen. And it's a challenge for policymakers, particularly as growth is also slowing in many of these countries, including in India.
Jonathan, so, if Fed starts to taper come September, what kind of trend do you pick up for fund flows into emerging equities like India?
Well, we had a very big outflow in June. In fact, the largest dollar monthly outflow in the history of emerging markets. And it's probably more important that though that's abated somewhat, the fixed income outflows from local currency EM fixed income particularly have been very persistent now for 13, 14 weeks. And that's a sea change from what we saw when we had a weak dollar and very low US rates in previous years. It does seem that there's really, to use the metaphor of the tide going out, which we did in our early June blue paper, there is a tide that's going out here in global capital flows. They're flowing away from the emerging world. They're flowing back into the core, not just to the United States, but actually Europe as well, where incrementally growth is picked up, and a country like the United Kingdom is picking up quite dramatically. But that relative growth differential is affecting large parts of the emerging world, not though all countries. China, which self-funds, is not reliant on global cost of funding, has experienced a growth pickup in July, and there's early evidence that's continuing into August. So that does shape some of our asset allocation within EM.
Jonathan, whereas there is a visible problem for emerging markets in general as an asset class, do you think for Indian equities the problems could compound going forward? Because India clearly is an overweight position for global investors, and if money reverses from emerging market equities, an overall market like India, which is still an expensive market, could get hit the hardest?
Well, it's a tricky conundrum here. There's some very strong business models bottom up in corporate India that generate very high ROEs. Some of those are exporters and do well when the rupee weakens. But our overall stance on India has certainly moved to be more cautious. We're underweight for the Asia ex-Japan investor. neutral for the EM investor. It's not the most scary situation from an external funding need in the countries that we cover. We're actually more concerned about somewhere like South Africa, that's our largest underweight. But certainly we're not overweight India, have not been for quite a long time. And you're right that if you look at the consensus fund flow information that we have, the average portfolio manager on an EM basis is around 400 basis points overweight India. So that holds about 10% as of the end of June, the benchmark weighting being 6%. That overweighting has been very persistent, and it's unlikely to suddenly reverse. But at the moment, we would suspect that India is a kind of neutral performer versus EM and an underperformer versus Asia ex-Japan.
Jonathan, really appreciate your time, and thank you for joining us.